Hello, everyone. My name is Moonshine, and I'm the host of today's AMA with Stable. And what is Stable really all about? We're going to see um, how Stable is going to offer features like capital efficient liquidity pools, smart liquidity routing, and arbitrage tools. And all of these features is what is going to allow traders to minimize price impact and slippage, while liquidity providers will benefit from high capital utilization and yield farming opportunities. So, as we dive into each of these features and utilities that Stable plans to offer, Euclid is going to give us details on how they are going to implement all the strategies to achieve their goal. So, Euclid, we want to start by you introducing yourself to us and introduce the team to us, how many you guys are, and history and foundation behind Stable.
Yeah, cool. Sounds good. Thanks for the intro, Moonshine, and I'm happy to have the opportunity to present here today. So let's get started with Stabble. We are actually a project founded 3 years ago. And 3 years ago, when we were looking, okay, what do you want to do? Which type of product do we want to launch in the market? I mean, all of us were from the beginning, or at least the founding team from the beginning on, was very interested into the Solana ecosystem and also DeFi. So we had a deeper look into DeFi, the DeFi ecosystem in on Solana, and what we actually figured out is that the DEXs, and I mean that does also account for other DEXs on other ecosystems. It doesn't matter if it's Solana or Ethereum or other ecosystems. We figured out that these DEXs have problems when it comes to capital efficiency, and these problems in terms of capital efficiency can lead to lower APY, higher impermanent loss risks, or bad pricings for the trader. And we thought, okay, what could be a way to make DeFi and DEXs more capital efficient, so in order that these problems don't occur anymore. And that is actually where we came up with the idea of Stabble, building a protocol that solves these problems. So we came up with some features. Let me explain them feature by feature. So first of all, we have a completely new pool architecture that allows us to be more efficient compared to other DEXs. So that means the volumes that we can capture with a certain amount of liquidity is way higher compared to our competitors like Orca or Radium. For example, we are 80% more efficient. So that means we need 80 times less liquidity compared to some pools on Orca or Radium in order to capture the same or more volume than they do. So that means this capital efficiency is resulting in way higher APYs for the liquidity providers. And if you look at our dApp, we are live for 6 months now. You will find APYs that are way, way, way higher compared to the whole Solana ecosystem, because our APYs are, let's say, for example, we have stable pools where you can get close to 30% APY at the moment. I think the annual APYs are something like 50, 60% so far. So that is really a huge increase in terms of capital efficiency and makes us to one of the most interesting places for liquidity providers if you want to provide stable coins or LSD tokens on the Lana chain in order to yield to farm some yield. And other than that, we also came up with more features to make our protocol even more efficient and also make it to offer our users a better user experience when it comes to providing liquidity. So one feature is called smart liquidity routing. Smart liquidity routing basically means that the protocol will manage the liquidity on behalf of the user. And depending on where the more trading activity for a certain pair or token or coin is happening, the protocol will then distribute more liquidity towards that pool. For example, imagine you want to provide liquidity using USDC. What then happens is, and let's assume you want to stay only within stablecoins. What then happens is that our protocol, you can stake, or first of all, you can stake that amount of USDC. And then our protocol will take that amount of USDC and distribute it to the best stablecoin pools on our protocol with the highest APY, and rebalance that allocation on your behalf so that you always make sure you are involved into multiple pools depending on where the higher APY can be generated. So these pools can then include in that example USDC, USDT. It can be USDS, USDC, or our USDS, USDT, and USDC pool. So depending on where the higher APY is, the liquidity will be used and utilized by our smart liquidity routing bot. Then we also have smart liquidity arbitrage. Smart liquidity arbitrage is an additional way to generate yield. This is actually a very interesting thing because this doesn't exist so far, nowhere in the ecosystem or also not another ecosystem. But arbitrage pools basically execute trades, arbitrage trades across the whole Solana ecosystem for certain coins or tokens. So that means if you want to use USDC to execute arbitrage trades, you can stake your USDC into our USDC smart liquidity arbitrage pool, and then the protocol will make use of that liquidity in order to execute arbitrage trades and actually transform that or return a profit, and that profit will be transformed into your yield that you can generate by just staking that one token. So this is actually also a very interesting way to earn yields in DeFi because this has not been previously used by any other protocol. This is actually, I mean, the market we're tapping in here is actually the arbitrage market, and arbitrage market is a huge market. Arbitrage is responsible for lots of trading volumes in ecosystems. That does not only apply to Solana. We can also, if we look at EVM, for example, there we also see lots of arbitrage activities. And to give you a number, usually with most DEXs, it is the case that they lose up to 27% of their TVL due to arbitrage. But actually, the fees that protocols are earning make up for that amount of money. So basically, no one can see that number unless you really look deep into the on-chain transactions and have some statistic based on data analytics. But actually, this is the amount of money that is possible to capture as a protocol and actually to give it back to the user. So this is our huge goal here. And then on top of that, we also have a new type of liquidity pools. And these new type of liquidity pools are margin liquidity pools. So that means, I mean, you might already know the normal AMM pools where you have like multiple, or can be two assets, or it can be multiple assets in our case, that are within that liquidity pool, and users provide liquidity for the whole price range of these assets. But actually, with concentrated liquidity, which is the second type of liquidity pools that's existing there, this does not apply anymore. Users can choose for which price range they want to provide liquidity. So this is actually huge, or a nice tool in order to increase the capital efficiency as well, and in order to make sure that you can basically control your impermanent loss risks. But actually, this is also not the most efficient way, because the most efficient way is margin liquidity. So margin liquidity works in a way like executing a margin trade. So that means you are leveraging other money, external money that you don't own. You're borrowing that money in order to provide liquidity with that money. And that means you can then provide, let's say you want to provide 3x liquidity compared to what you own. By doing so, you could would be able to earn 3 times the APY. So yeah, this is actually what we have built. We haven't deployed all features yet. We deployed our core protocol with different pools and with different tracking options for the pool performance, with different management options for liquidity providers or also pool owners. So we have quite an advanced DEX already, which is already live for 6 months now. We are having, I mean, we just released our roadmap a few weeks ago for 2025. And we have a set of great features lined up, all the ones that I mentioned previously, that will be, it's realistic that we will launch these features within the next couple of months. And some features might take a little bit longer because they are very complex and they have to be carefully audited and so on before we deploy them. But within 2025, we will definitely deploy all the features that I just mentioned. And yeah, I hope that we will even grow more, because so far we are a very, I mean, heavily used DEX within the Solana ecosystem. We are one of the biggest DEXs that is out there. I mean, most of you might already know Orca, Radium, Infinity, or Phoenix, and actually we are. It depends. Sometimes we're the fourth biggest, sometimes we're the fifth biggest. DEX on Solana. And but if we look at what we've all lined up for the future and as future features for our protocol, I'm very optimistic that we will definitely further grow within the Solana ecosystem. And to give you some numbers, we have up to 600,000 daily active users. We have up to 600 million daily transaction volume through our dApp. And we are currently, we have around 50% of the overall stable transaction volume on Solana is generated through or is executed through Stabble pools. So yeah, we are in a great position right now, or positioned very well for. And then if we look at what's about to come in the future, I'm looking or I think it's a very optimistic outlook in terms of our future growth. And yeah, so this is actually Stabble, the protocol Stabble. Then we are also launching our token. We will launch our token in Q1. We are about to finalize everything and to announce the TGE date that will happen quite soon. And currently we are, trying to reach out to new communities, attract more users. We want, users can become our protocol users. They can swap on our protocol, provide liquidity. Then we are also hoping to get some investors interested in buying our token at the IDO, or after we did the TGE. And of course, what's also always interesting is you always have the opportunity to join our airdrop. We have a larger airdrop lined up. So the first airdrop season will be closed at the TGE, but then we have 2 more airdrop seasons that will reward you by just using our protocol. So providing liquidity, executing swaps is directly rewarded with our own token in the next coming month. So this is, everything so far I wanted to mention about Stabble. And I'm happy for the conversation, and let's do a deep dive into some details.
Nice. Really, really enjoyed your details. Your explanation was very in-depth and detailed. I really appreciate that. It just shows that you guys are very intentional about what you plan to offer to the outside investors, to the listeners, and I really want to commend you on that. So while you were speaking, I think areas that I really wanted to touch on too is particularly the liquidity pools and incentives, because that is one of the backbone of every project, especially with the kind of projects that you guys are building. So I see that 86% of the fees is generated to liquidity providers. So my question is, what algorithm determines the distribution of 86% of the fees generated to these liquidity providers across both weighted and composable stable pools? And the protocol that is used to calculate the total APY for these liquidity providers, what factors contribute to it? Is it the fees, token, rewards? I want you to throw more light on that. Did you get a question?
Yeah, I get. Sorry, I was muted. Sorry, I forgot to unmute myself. So it is quite easy to understand and to explain. So basically, we as a protocol, we earn trading fees like all other DEXs, or also like centralized exchanges, and we are using these trading fees in order to reward the liquidity provider on the one hand side, and also our community and token holders on the other hand side. So as you mentioned, the fee split is 86% goes towards the liquidity providers, and 14% goes to the stakers, or token holders. So if we look at the 86%, the reward is distributed. I mean, it is distributed on a pool by pool basis. So that means each pool is rewarding the users depending on how much trading is happening within that pool, and also depending on how much liquidity is provided within that pool. So let's imagine we have like there's a pool that has 100 million in trading volume. Let's keep it easy. Let's assume the fee is 1% for the trading, and after these 100 million have been traded within that pool, that means there's 1 million in fees. And depending on how much liquidity you have in the pool, let's assume you have 1% of the pool's liquidity, or you had 1% in that pool when the trade was happening of 100 million. So that means the fees are 1 million. And out of that million, your share within the liquidity pool is 1%. So that means from these 1%, first of all, we have to subtract the 14% from the fee that goes to the stakers and token holders. So that means we have 860,000 fees left over that we're distributing to the liquidity providers. And 1% out of that is 84,000. Yeah, I'm right. Yeah, 84,000. Yeah. So that means 8,400. Sorry, my bad. 8,600 goes to you as a liquidity provider if you own 1% of the pool. So that means it's linearly distributed according to the weight that liquidity providers have in our pools.
Nice. Thank you so much for answering that question. So now, in terms of security, I want to know what safeguards are in place to handle liquidity drain or withdrawal spikes in composable stable pools, and like measures that are implemented to prevent pool exploits, such as flash loan attacks or price manipulation.
Yeah, we have, first of all, in terms of security, we are fully audited. And when it then comes to our, to people that potentially could drain the pool, that can only be done by the liquidity providers themselves. So that can't be done by anyone else, because that is something we have that's determined in the smart contracts themselves. And so that means if there is a pool getting drained because users are leaving the pool, that is actually not really a threat, because you can always just take that money out of the pool that is actually your money. So that means there is no option that you, for example, take money from other people that have deposited in that pool. So basically, it is always, even if there is a pool going to zero in terms of the money that is in the pool, or in terms of the TVL, that still means that each liquidity provider can withdraw their proportion that they had in the pool. So that means there is no such risk that you're losing money due to that. So this is very important. That's some kind, or the part of our core infrastructure. And we really made sure that this is properly implemented by our devs, and also properly audited by our auditing firms. We got audited by Neodyme and Sex3. And so this is our measurement to make sure that, or our action to make sure that we are quite safe in that regard. Moonshine?
Sorry about that. I had some issues trying to unmute my mic. Telegram is just
No.
so weird today. I don't know what's wrong. So still on that, I wanted to know, what is the maximum number of token pairs supported in the single weighted pool, and how does this actually affect computational load?
Yeah, so you mean the total pairs that we have in our weighted pools, right? I'm not sure, honestly, how many different pools that are.
because each user can just create pools however they want, whichever they want. So we don't have any control over that, and we're just monitoring the pools or taking care of the pools that we actually deployed, and our users can do whatever they want with their pools. And it's in their interest that their pools are performing well, because by doing so, they will attract more liquidity and gain more volume and actually generate more yield. But I'd assume we have, in terms of weighted pools, composable weighted pools, we might have 60, 70, 80 different pools. So that means, not twice the number of different tokens, because some pools are quoted against, or lots of pools are quoted against the dollar or Solana. But to give you a number, I think it is somewhere in the range of 60 to 80, 90 maybe, different pools that we have currently live on our protocol.
Really interesting.
Yeah.
Um,
And
mhm.
in terms of what you mentioned, in terms of the computational power, the total amount of pools that we have doesn't have any impact on the computational power. For us, it's more important that the pools that we have, that they have an architecture which does not use much computational power, because that would decrease the performance of our pool, and decrease performance of our pools could lead to unwanted pool behavior. For example, that orders don't get executed properly, that they get reverted, and that leads to less volume, that leads to lower APYs. So we have made sure that we are quite clean when it comes to our pools and the core architecture of each individual pool that that people can create on our protocol.
Nice. Thanks for answering that question. I was about to ask, okay, so now considering the slippage, I wanted to know, does Stable integrate price oracles like Chainlink or PEAT to ensure fair market rates during swaps?
Now, so far we didn't integrate something like that, because actually oracles are decreasing the performance. I mean, of course, they increase the if price efficiency when it comes to the trader's perspective, because they always offer good prices. But actually building in oracles into smart contracts that have to perform on a very, very quick level in order to execute a transaction without resulting into high slippage and being reverted, etc. So that means we do not have any intention to start using oracles. But instead, what we will do, I mean, that's one of the features that I mentioned. We have the smart liquidity arbitrage pools, and these pools basically will ensure that we are executing arbitrage trades across the whole Solana ecosystem. And we are also doing that with our pools as well, because our pools are very important in the ecosystem. And that means if we are executing arbitrage strategies between our pools and also Orca, Radium, Lifinity, and all these other DEXs, we are kind of automatically making sure that the price on our protocol is always matched to the price of the other protocols. So basically, this eliminates the need for an oracle in our case, if once we have that feature.
Nice. I was really curious about that. Thanks for the answer. So, during high network congestion, which may occur in the future, as you would have, more users into the ecosystem, how does the system prioritize transactions during high network congestions to ensure swaps are executed efficiently?
This is a good question. I'm not sure if I can answer that honestly. Let me think about it, but this might be a question that really our CTO is only be able to answer you now. I'm sorry. I think I'm not able to answer that, and I don't want to tell you something that is not really true or only half true. Sorry.
Okay, I mean that's why there is a team for every project, you would have some specific individuals who are focused on that particular aspect
Yeah.
and all of that. But you've been doing a very great job, covering what you guys are all about in specific. Now, let's just go to the token itself. Can you walk us through the use cases of the token and the ecosystem? And maybe you could as well just tell us about break down your tokenomic structure if you guys have one.
Yeah, sure. So, yeah, our token, I mean, one of the core functionalities of our token is actually rewarding token holders with the fees that our protocol is earning. I mean, that reflects to the 14% that I mentioned previously. And these 14% will be distributed to token holders via a staking program. So that means we're doing constant buybacks on the with the fees that we've earned that are ending up in our multi-sig treasury. And we're using these fees to buy back our own token and then distribute it to the token stakers. Then we have vested escrow tokenomics implemented. And vested escrow means you can lock our tokens in order to get VSTB tokens. And there will be a multiplier applied depending on how long you lock your tokens. So that means if you go for the longest period of or lockup period, then you will get 4.3x the amount of tokens. And these can be also staked in our staking smart contract. So that means you're boosting your rewards by just locking the tokens. So then we have also governance. Governance, I mean, this is pretty clear how that works. We have, we will set up a governance structure and architecture so that people can actually contribute or actively contribute to important decisions of Stabble and actually become owners of the protocol. And governance works in a way, or we also have the VSTB tokens that can be used into our governance actions. So that means, yeah, that works in a very similar way to the staking. So that means you can increase the voting power during governance votes. Also by 4.3x in total. And that increased voting power will, yeah, have an increased weight, of course, with all decisions that we're taking. And this also incentivizes our users to lock the tokens and to, yeah, lock the tokens and become actually more active also in the governance process. And we hope that it motivates our users to increase the voting power and the weight that they have within all governance actions. So that is so far the token utility of our token. We also have some, on top of that, we also have some fee discounts that are being implemented if you are a large holder. And then we also have, in terms of the tokenomics. Oh,
Me,
yes, sir.
you
Yeah.
adjust your mic, your voice is breaking terribly, just suddenly started breaking. So probably try to change your network where you are at the moment. So let's see if it's better.
Okay. Get it. Wait, let me switch to another network. 1 second, okay?
So we can catch all you have to say.
Yeah. All right. Can you hear me now better?
Hello, can you try speaking?
Yes. Yeah. Can you hear me better now?
It's still breaking, but at least it's a little bit better than before.
That's weird because the connection should be good. It's looking stable. And other than that, I'm using my headset for better audio.
Okay, sorry about that. I think I just got a text that everyone else can hear you clearly. So it's probably
Okay.
so you
It's
can
your, yeah.
let me try
Okay. Okay, then let me continue. I will continue with the tokenomics. So we have, first of all, our token is valued at 50 million fully diluted during our TGE, which will be, prior to our TGE, we will have the public sale. The public sale will happen at the 50 million. Evaluation before that, we had, when we started the project and launched everything and started developing and raised the first funds, we had an 8.75 million in the pre-seed and seed round. We also have a private round with the 12 million valuation, and the KOL round with also was 12 million valuation. So that means in terms of tokenomics, we are quite, I would say, valued at the lower end of what's possible in the crypto industry, and especially for a project that has like these high volumes. We have over 10 point something billion total volume since we launched. We have a decent TVL. We are generating lots of fees for our users. So that means, given these circumstances, we are quite lowly valued, I would say. And yeah, that's I mean, what else to add to the tokenomics? We have some TGE release for all allocations, and then we have, the vestings are relatively short, I would say. We are unlocking all tokens 100% within the first year, besides the team allocation. The team allocation is locked for 9 months and then distributed or unvested over 24 further months. So this is definitely one of the allocations that is locked for the longest and won't reach the market. And then also our company itself is holding an allocation that is locked for 5 years. This allocation is only be used to actually stake our own token and to earn money from that. That covers for all the expenses. So what is very interesting here is that we do not earn any money as a company. Other than that, we are instead, our company is just a token holder and a staker, like all investors as well. And the token that the company is holding, they can't be sold. And that is roughly 1/3 of the allocation. So that means you can even subtract from our valuations, you can subtract 1/3. So that means if I say we are launching at 50 million public valuation, in theory, that means that we are actually just launching at a 10 million valuation, because 1/3 of the 50 million can't be sold within the first 5 years. And then it's also unvested over another 5 years period.
Interesting. Thank you so much. So at this point, I think we should try to get in some community questions, and we have a lot of questions on the comment section. But let me allow Liz Noel to ask a question. Liz Noel, you have been unmuted. You can ask a question, mate. Yeah, I think Noel has some network issues, so I'll wait for him. Let me see if I can get in one question here from the comment section.
Hi.
Okay, hi. You can ask a question.
Okay, thank you for the privilege that you gave to me. So my question is that what are the strategies this team are going to plan?
We can't really hear you, Noel. Can you try speaking up? Okay.
Sorry, I have a network problem before. Sorry. Can you hear me now?
Yeah, it's better now. Please go ahead. Ask your question.
And then what are the strategies that this team have been planned to make this project go far?
Okay, I think we have gone over that, but Euclid, if you'd like to still, just
I can address that. So we have implemented multiple growth strategies these growth strategies are always, I mean, we separate between token growth and also the protocol growth, because this is a little bit different when it comes to how we structure the strategies and the target group, etc. So let me start with the protocol itself. So we figured out that growing the protocol is, I mean, the most crucial part of growing the protocol is through integrations and also through setting up the right pools by ourselves. So that means we are already fully integrated into major aggregators, for example, Jupiter, OKX, and Titan DEX, which is a relatively new one. And these integrations drive volume to our protocol. Then we also have some integrations lined up that further drive the TVL of our protocol. That can be with lending protocols that use our token as collateral for their protocol. So that means our users can basically, or their and our users can then loop their assets in order to multiply their yield that they are earning. And we figured out that this is crucial for us in order to grow. And this is way more effective than doing like lots of marketing, other than marketing around our community and with other communities. So what we're doing also very actively is AMAs with our community, and we have lots of content that we publish through different tools that can be X, that can be Telegram, that can be some form of Notion paper. So we are taking care of that specifically, of course, but the growth drivers for the protocols numbers are definitely the integrations and also the correctly set up pools. Because if we do, I mean, we as a tech team, if they are doing a good job and if we are setting up the pools in the right way, we have ecosystem outperforming pools. So that means our pools are automatically more attractive than other pools. So that means users are coming automatically to our protocol, and we figured out that this is the best thing we can do as well. So it's on the one hand side the integration, and on the other hand side we have the pools that we set up, and that just perform way better than the competition. Then when it comes to the token, we are relying more on the traditional marketing. So we have lots of KOLs lined up. We have some social media marketing lined up and PR marketing. We are using like this marketing mix to create a lot of traction and increase our user numbers for prior to the launch and after the launch of our token. Moonshine, are you there?
Yeah, I
Okay.
am here.
Okay, I didn't
Location.
hear you.
I'm so sorry about that. Okay, let's hear from Sujay. Sujay, you have been unmuted. You can ask a question, mate.
Hey, thank you, Moonshine. Hi, Euclid. Hope I'm audible.
Yeah, I can hear you probably.
Okay, perfect. Yeah. So just had a couple of questions. First one is very simple, but I just wanted to confirm: is there a limit on how many LPs one can participate in?
Yeah. We actually implemented that limit over the weekend because we thought, okay, if we have so attractive numbers that our protocol can deliver, and if we are able to have like low TVL, and that TVL can then capture large amounts of volume, and we don't need actually more TVL, why should we then let more TVL in? Because it would just ruin the APY for the older liquidity providers that are in the pool for a little bit longer than the new ones. So we definitely have figured out a way how we can limit the maximum of liquidity or TVL per pool.
Oh, okay. Yeah, that's kind of also what I had as a question. So that's how much you can invest in one liquidity pool. My question was also, do you have a limit on how many different pools I can invest in at the same point?
No, there's no such limit. Actually, you can use all our pools, and if you want, you can put $10 in each pool.
Ah, nice. Okay. So I can have a stake in every pool that's available if I wanted
Yeah.
to. Okay, cool.
Yeah. If you wanted
Cool.
to.
Cool. A second question. There's something I came across on one of your posts. I think this was last month. You had some sort of a bug in the transaction indexer, which caused the volume and APY data to go missing. I just wanted to understand what it actually was and how you went about fixing it. And when it was identified, did it actually cause any monetary loss, or was it just that people could not see the numbers in real time for that
Yeah.
amount of time?
So actually, the problem is with all the tools that we are using, that we use to build our protocol, is the scalability. And if you have like these huge spikes in terms of volume, let's if that's for example for one specific pool the case, the scalability is just not there from the transaction indexers that we are using, or had been using. So that means it just started. I mean, the transaction indexer just started to not count the trades anymore because it couldn't scale, and it was like it couldn't catch up with what happened in the past. So it just completely stopped doing the job. So that means after it stopped doing its job, we figured out, okay, it's showing that there's literally no trading volume. But if you then look at the blockchain data itself and at the smart contracts, we thought, okay, but there is still volume. But actually, or unfortunately, that the transaction indexer didn't work resulted in our pools displaying like 0 APY, and that actually did harm us financially because it happened during the worst time possible. It was during Christmas, of course. These things always happen during such times. So lots of users were just scared and thought, okay, I'm going to withdraw my liquidity. Stabble is not driving any nice results anymore. And but after we fixed it, actually we grew even better in terms of the TVL. So the whole TVL that we lost during the huge fail of the transaction index the first time we had it, that just recovered in a couple of days and then grow way further. And so we are fine right now. And but of course there was like a week where the TVL was quite low compared to where it was before. So yeah, it was a little bit tricky, but now it seems to be solved, and with a little bit more reliable infrastructure and other protocols or products we're using to handle all these indexing.
Oh, perfect. What was it a code fix that was required, or was it just capacity? Was it a resource crunch that it was not able to handle such high volume?
Yeah, it was the capacity only. They were just not
Okay.
able to handle that volume.
Okay, got it. Hey, thank you so much for answering my questions. You've been around for so long. I don't know why I had not heard of you before, but I have now. And it's really
Yeah.
impressive what you've been able to
Yeah.
achieve. Not many
Nice.
projects stay around for years together. So
Thank you.
wonderful job, and all the best for the future too.
Thank you very much.
Thank you, Moonshine.
Thank you so much, TJ. So I'd like to get some questions from the chat. So this person says, can you discuss the role of stable DAO in protocol governance and how STB holders influence decision-making processes?
Yeah, I mean, this actually works in a way very similar to all other DEXs and the other protocols that we know on Solana and also other ecosystems. So basically, all important decisions will be made by the DAO, and everyone can participate. So basically, everyone should be able to create a proposal, and that proposal can be discussed in our community. And once it's discussed and it makes it to the vote, we can initiate a vote where all DAO participants can then vote on that proposal. We saw, I mean, if we look at successful examples of good DAOs and on this Lana ecosystem, we always have Jupiter. They're doing it in a really great way. So that's something we are trying to achieve as well.
Nice. I hope that answers your question. This one here says, Can you explain the function and acquisition process of the stablecoins booster NFT and how it affects airdrop rewards?
Yeah, it's quite easy. So, I mean, there are two types of generating or earning points. You either execute swaps directly on our dApp, or if you don't provide swaps, or if you don't execute swaps, you can provide liquidity. And or there's also a third option. You can create a liquidity pool and to provide liquidity for that liquidity pool. So you have these three options to earn points. And if you are owning a booster NFT, the earned points will be multiplied by 2.
Nice. I'm just trying to get in more questions, so more people's question can be answered. I had a question here and I think I lost it. This one says, how does Stable plan to adapt its protocol to accommodate emerging trends like real-world assets or decentralized physical infrastructure networks?
Yeah, this is a tough question because we have to see where there is an option to work with these kind of projects, because we just deliver critical infrastructure for the ecosystem when it comes to trading. So that basically means if there is a token involved, let's assume for RWAs, of course, we can work with these projects and list their token, and also do some kind of integrations if they want. For example, if a project is deploying RWAs, we can create a partnership and do some integrations. For example, that we offer our liquidity pools for their assets and deliver a widget for them that they can create, or that they can implement that widget on their website, for example. So this is the only way how we can work with other protocols that are not directly linked to DeFi. But for us, every protocol that has a token is definitely interesting, especially if it's a highly traded token, because we list all these tokens or lots of tokens, and we are also doing it by ourselves just to grow the protocols, amount of pools that we have and the amount of options that users can have when they're trading on our protocol. So this is also something we are definitely doing. And but other than that, it is, if a project or protocol doesn't have a token, it's not that interesting for us at all.
Nice. I think before I wrap up this AMA, I'll just like you to walk us through the kind of partnerships you guys have currently and your roadmap, the things you guys plan to do in the coming weeks.
Yeah, sure. So in terms of the partnerships we have lots of integrations into Jupiter, OKX, um, Titan DEX. These are all integrations into aggregators. Then we have some partnerships when it comes to the NFT distribution. For example, we have a partnership with the Jupiter DAO, with the Magic Eden wallet, Soulflare, like all these different providers that, infrastructure providers that help us to distribute our NFT or booster to their communities. And then we also have some partnerships with other protocols that have tokens out, mainly some meme coins. These meme coins, some of them have additional emissions that they offered to our liquidity providers. So that means we have the APY that is organically generated by the protocol itself, and then we have some additional emissions which boost the APY. And some of these pools are boosted as well, so that users that interact with the pool and farm points, they will also automatically gain higher amounts of points. So usually boosted pools are always boosted by 2x. So that means the amount of points earned when specific pools is also getting doubled. So that's in terms of that's what we have huge in terms of partnerships. And of course, we also have some other smaller partnerships with marketing firms, with centralized exchanges, launchpads, and all these. And of course, not to forget our investors. So we have a large amount of investors that supported us from the early beginning. Yeah. And then we have, when it comes to our roadmap, what we have lined up is, I mean, within the next couple of weeks, we have one very important topic. That is our TG. So we are planning the TG. We're planning all the marketing for it. We're planning lots of AMAs. So everything basically that you need in order to conduct a successful TGE. And then we have like some development milestones. Very important is, because we need it at the TGE, is all the staking infrastructure. It is the lockup infrastructure for the VSDB tokenomics. We also have like a function in place that users can stake locked tokens, because it would be unfair to lock tokens for longer of some users that invested quite early, while other users that buy the tokens directly from the market, they can then, for example, stake directly, which our early investors couldn't. So we found a way how we can make that more fair to our community, and especially to early investors. And this is also getting built. And if we're done with that, if we're done with all the infrastructure or product features that we need for the TGE, we will then continue with our core features that I just mentioned earlier, that we will also deploy, I would not say in the coming weeks, but in the coming month.
Very interesting. Personally, this was a very engaging AMA. I usually like when the speakers, go back and forth, try to cover every and each aspect of the project. Makes it very interesting and easy for users to actually comprehend. So thank you so much, Yukli. It was nice having you. I want to also say a very big shout out to everyone who was listening, everyone who sent in a question. And I'm sorry if I wasn't able to get across all questions. So guys, join the socials, ask whatever questions you have. Try to get updates about Stable. That's the only place you can get legit information. These AMAs are not financial advice, so do your own research. And you could always listen to this AMA once again, because it's being recorded. And before I close down the VC, Euclid, I'd like to give you the chance to give your final statement.
Perfect. Yeah. Thank you very much, Moonshine. It was a great AMA. It was great to talk about Stabble in such detailed questions. And I also want to thank the whole community listening or joining that AMA, and also, of course, participating in all the questions and discussions. And thank you.
Yeah, thank you, everyone. See you all in tomorrow's AMA. Bye, guys.
Bye-bye.